Now, even though large caps have underperformed the small caps, that's where our market monitor is still finding opportunity. Now, last time he was with us on this program back in February, he recommended these stocks: Abbott Labs, which in the last 3 months is up 10%, Accenture, which has gained 13% since he was with us in February, and Medtronic, which is up about 1.5% in that time. He, by the way, is Jason Pride, Director of Investment Strategy at Glenmead, an asset management firm with $29 billion under management. So, Jason, you still like these stocks. I guess that's the definition of a long-term investor anyway, isn't it?
Well, you know, this is an interesting environment. We've got the U.S. equity markets, which are a little bit overvalued. And I believe one of your guests has already commented on that earlier, and international markets which are at the discount. And that's really one of the places where you want to take risk. But in order to offset and really manage an overall portfolio, if you're going to take your risk by picking up a little bit more small caps because the valuation's better there, and a little bit international because the valuation's a lot better there, then you need to de-risk what you're doing in the large cap space. And you can do that by playing an equity income, kind of quality dividend growth sort of focus. And when you do that, you pick up things that are primarily, you know, the better valued opportunities right now are in the healthcare space, even with the run that we've seen in Abbott Labs. Okay. And you find little opportunities across the board with things like Accenture, you know, a global IT outsourcing firm that has great growth prospects, but a really nice, stable franchise, nice dividend, and nice growth of that dividend over time.
So you're almost using these as a hedge against the riskier side of your portfolio, but with a gain of better than...
That's basically what we're doing.
Yeah, in Abbott Labs up 10% and Accenture up 13%. You're not tempted to take a little bit of a profit there?
Well, you know, we have been taking a little bit of a profit. We've actually added to our small cap exposure recently. We've been keeping a very healthy international equity position, but really these act as a nice offset to what is otherwise a slightly riskier exposure in other parts of our equity portfolio, and the fact that, truthfully, we're also overweight equities at this point in time and underweight fixed income. So we really need something to provide ballast in the portfolio, and one of the most attractive opportunities to do that is this equity income quality space, whatever you want to call it, but the idea of playing defensive within your large cap portfolio.
Very quickly, I know a lot of our viewers, to go get income in the equity markets, look to utilities, which have been beaten down, perhaps anticipating higher rates. Would you look there as see some value there at all?
See, that's an interesting dichotomy that's happening today, is basically the things that typically would be categorized as high income or high growth. Those are the overpriced areas of the equity market, and this safety area of quality defensive equity, things that I call dividend growth or equity income, those are the areas that are more attractive. So it's not a situation where you want to chase either the highest growth or the highest dividends. You actually want to go for the things that are the most stable within the large cap space. That's not true across the board.
Point well taken. Jason Pride of Glenmead, good to see you again. Thanks for joining us tonight.
Thanks for having me.